Hello everyone and welcome back to the Master of Money program. I'm Steve Beeman, your host. And whether you're joining us live here in Oak Brook, Illinois for our meetup meeting that takes place right after the video, or you're joining us through the Ustream video around the world, we're awfully glad you're with us. Now tonight, we're going to be talking about a topic as old as investing itself. We're going to talk about risk. Now the question is, how do you define risk? And how has Wall Street smooth-talked millions and millions of people into defining risk in a way that may actually increase their risk as they approach retirement? So tonight we're going to explode one of the major myths on Wall Street, and we think you'll find that especially interesting. Now last week we had an opportunity to interview Jeff Garbaz, my good friend, who talked with us about his trading experiences and how he's worked to improve over time, how he trades. We talked about the biggest mistakes people make, as well as methods they can use to minimize those mistakes. And Jeff turned us on to some of the tools he uses to get the best information he can to execute the best profitable trades he's able to. Certainly, if you had any questions about last week's program, feel free to email me at questions@safefinancial.org. I'm always looking forward to the questions we get. It's very interesting to see them, and I love responding to them. So don't forget to write, again, questions@safefinancial.org. Now, in addition to the trading session we talked about with Jeff, I updated you on the Society's effort to build investment clubs around the country. We're very excited to get these going, and right now, we have 2 of them in the works, one here in Chicago and quite possibly one on the East Coast. So we're very excited about that. And if you would like to learn more about how you can build or participate in a safe sponsored investment club, please write me again at questions@safefinancial.org. That's a real exciting way to put the rubber to the road, so to speak. Now tonight, I took a question out of the many that came in, and I thought it was appropriate to answer it because we're approaching tax time. It's just around the corner. And one of the questions that came in said, Steve, how will the Affordable Care Act really affect my taxes? Well, I thought I'd touch on that because H&R Block is certainly making a big deal of it this year. And let me give you kind of my 2 cents as chairman of the society. First of all, for the vast majority of you, it won't do anything. The reality is there's a little checkbox on the IRS 1040 form that says, do you have insurance that complies with the ACA? Well, most of you do, so it's just, yes, I do. For those of you who don't, and that's where the question will come, you have to say no, and there is a fine that can be appropriated to you of about, I think it's $100, $200. Now, the interesting thing about this fine, it can only be collected on a tax refund. So if you're not getting a refund of your taxes, they can't collect the fine. So for most people who don't have insurance, that fine will never come into play. Now, if you do have a question about whether or not your policy does meet the national guidelines, if you got your policy through one of the exchanges, almost by default, it meets the guidelines. If you've had a policy grandfathered in, like mine, I have a Blue Cross policy I've had since 2008. As it's grandfathered, it meets those guidelines as well. If you have any serious question as to whether your plan hits the guidelines and therefore exempts you from any further information, just ask your insurance agent. I'm sure they can get you the scoop on that. It's actually not going to be that complicated. Just remember, it's a 2-part question. Do you or don't you have the insurance that meets it? If you do, it's no big deal. If you don't, be prepared to have a little fine given to you, but it's a fine that you very well may not ever have to pay. So that's our answer to that. I hope it does give you some insight. I don't want to go too detailed into it, I should say, because I don't know your specific circumstance. And it's extremely difficult for me to talk about whether or not your policy would be accommodative of it without knowing what it is. So I would urge you, either write us if you have further questions at questions@safefinancial.org or talk with your insurance agent and let them determine whether or not your policy that's in effect does that for you. Now, in the geopolitical world, we're topped on the list once again by Greece. I mentioned to you a couple of weeks ago that they had an election in which a new group, Syriza, took power. Their original thoughts were that they were going to restore minimum wage, restore the government programs that had caused the problem in the first place, and renege on the Germans' loans to Greece. Well, after the election last week, they backed down on that a bit. They're now saying that they will repay them, but they want renegotiated terms. Now, the reason I put it at the top of the list is this continues to cause a problem as it relates to the European Union as a whole. When you look at the situation in Greece, the situation in the Eastern European nation of Ukraine, not part of the EU, but bordering on it, when you look at the terrorist activities in France, when you look at a lot of the issues going on in the EU, you can start to paint a picture where the EU itself doesn't last very long. We'll have to find out, but that's a critical thing as it relates to global volatility. Now, I found it interesting as well. I couldn't understand how this new prime minister of Greece could rationalize not paying back the Germans. Here's how he did it. I thought this was interesting. He came into office blaming the European bankers for loaning Greece the money. His argument was it's like a drug user who the pusher is pushing more drugs on him. Now, you and I both know that in the United States, for example, we're running massive deficits and an $18.5 trillion debt. Borrowing money up from the government standpoint is a little bit like that. Well, here's the problem. What's the alternative? In Greece, had they not taken those loans, they would have had a complete meltdown of their economy. So yes, I would agree with him that banks making bad loans to companies or governments is inefficient and in the long run hurts. But in the near term, when you look at Greece or you even look at the United States in 2008 and 2009, would you rather try to figure out a moderate solution or would you rather have a total collapse? We faced it in 2009 when Bernanke turned on the spigot, and they faced it in Greece when the European Union jumped up to give them more money. We know it's dangerous, but I would make the argument to the new leadership at Syriza in Greece that you didn't really have a choice. You've got to get your spending under control, you've got to get your economy back on a productive level, and then you won't face those types of issues. So we saw that with Greece. Number two, I found it interesting in two different parts of the world an issue came up. Brazil is suffering from a major water shortage, a real drought this year. And it's a question whether or not that will prevent them from having enough water resources to support their population. That's a real fear. And over in India, they're having the exact same problem. Because of explosive population growth, they're not able to get enough water to support the population. Now, these are strategically big problems, but I want to share with you a solution that is on the horizon. A few weeks ago, we talked about disruptive technologies. Well, let me share with you one of the most disruptive technologies is a new super material called graphene. Graphene is a composite material that's been discovered it's got a lot of characteristics, but one of them is it is a perfect filter for seawater. You literally can run things through it, and the only thing it lets through is water. It's a perfect filter. It's also dirt cheap. Now, the reality is graphene research isn't at a commercial level yet. It's going on all over the world. But in the relatively near term, and I mean next 5 years, I think you'll see a graphene-based solution to the water problems in Brazil, India, and even parts of the other parts of the world suffering from drought. So this is a reason that we can sustain optimism. Technology has a wonderful way of bailing out bad policies, and to the extent water usage has been a problematic policy throughout the world, technology may just be giving us the capability to build an unlimited resource of drinkable, usable water. So I thought that was an interesting story because, again, it shows you the interaction of the world and how interlaced the world is on these geopolitical issues. The final issue I thought was really interesting, and frankly, it's a little bit scary to me. The Russian Congress or Parliament came out last week and made a statement about how they regret the reunification of East Germany and West Germany. Now, that's a really big statement from a country that has begun to move into its eastern neighbors, Ukraine, has been flying bomber flights off our coast in the Alaskan Air Defense Zone, has been sending nuclear submarines into Finnish waters and most recently sent a nuclear sub into Cuban waters. We don't want to see this out of Moscow right now. We know that economically they're hurting because of sanctions imposed because of their own actions. If they back out of their aggression in the Ukraine, we'll back off of the sanctions, and just maybe Russia will be able to rebuild an economy. But Putin seems, just bent and determined on rattling the sabers and causing more trouble. Well, as always, we closely monitor Russia. There's a group I follow on the internet very closely called Stratford Research, and they talk about nightly what's going on around the world. And as they report to me, I report to the members of the society. So we watch this German-Russian situation. Finland is a little bit worried about Moscow right now because Moscow's indicated that Finland is a country that isn't part of NATO and they could annex. Well, these are scary thoughts from Mr. Putin, and we want to make sure he doesn't go any further than just having thoughts. In economic events, we want to move quickly to a summary of the Davos Accords. When the world leaders met last week in Davos, Switzerland, and you and I spoke about that, one of the key things was the Trans-Pacific Partnership. This is a global free trade agreement between the United States and a number of the Far Eastern countries. I'll notably exclude China from that. But it opens up a global free trade zone. That's a good thing, generally speaking, but as always, the devil is in the details. The Trans-Pacific Partnership has some language in it that is very concerning for Americans. First of all, there are some regulatory stipulations that allow companies to come back and recapture profits from the U.S. government if it is deemed through the Trans-Pacific Partnership system that those regulatory systems in the U.S. hurt those companies' profits. Now, that's a little complicated, but what's happening here is this Trans-Pacific Partnership is setting up an outside or extra-national court. And if companies go to that court and claim that a given country's policies hurt it, they can collect. That's a little bit dangerous because you're getting out of national boundaries now. If companies want to be global, and we respect that many of them do, they still need to abide by the laws of the nations in which they operate. And the Trans-Pacific Partnership is a step to take them out of that. Something to be concerned about. We'll keep you posted how the TPP proceeds through the Congress. Secondly, the U.S. economy, we've reported to you, it continues to be bipolar at best. You get one good piece of numbers and data followed by another bad one. We reported how December started strong but ended up kind of weak. We have housing starts now that are trending down, but manufacturing output seems to be good. It's a bipolar economy, and it's simply indicative of the fact that you and I've spoken about it, that we're in a very anemic recovery. We are not on a strong, stable, and supportive recovery at 4 or 4.5%, but we're kind of slipping along at 2.5%. The markets aren't real sure of where they should go. You've got Europe slowing down, the Far East slowing down, the U.S. trying to sputter as the little engine that could, but it's not sputtering very well. So you're seeing these cross currents. All of that has resulted in a very, very poor January stock market performance. We're going to touch more on that later in the program. But the fact of the matter is this economic malaise that we're in seems to be sustaining. You see consumer confidence go up, but then one little thing happens and it sure drives right back down. I've equated the market to a guy who's sitting there with a trigger on a gun and he's ready to pull the trigger, but he said, okay, I'm going to pull it if that happens, and on a hair, if something changes, they pull the trigger and get out. They're afraid. They're scared that the markets are going to get hurt. It's reasonable. We understand it. The VIX has run up radically in the last few weeks again, coming off of that downswing, and it's indicative that the institutional world sees volatility ahead. But this economic malaise that the United States is under will sustain, sadly to say, even though yesterday, Groundhog Day, I think Puxatawny Phil said 6 more weeks of winter. Well, I think we're headed towards 6 more weeks of economic malaise. Finally, a little note on an interesting, I'm not sure where to call it. Is it a financial and economic or a geopolitical thing? But Bitcoin, that cryptocurrency that came out and made such news a few years ago, has once again reemerged and is becoming legitimate. The United States, of all places, has actually said they're going to begin to regulate Bitcoin. Well, that regulation makes it legitimate. If you're not familiar with it, Bitcoin is what's referred to as a cryptocurrency, meaning that it's an internet-based currency in which it's based solely on a credit in an account. Now, people, especially if you're 50 years like I am or above, say, whoa, I want nothing to do with that. What's the real value? Well, the Bitcoin argument is the dollars you hold in your billfold have no value either. The only issue of scarcity is self-imposed, and Bitcoins have self-imposed scarcity. So the idea is that retailers can take these Bitcoins just as they take $1 or €1, and they can transact with them. More and more retailers are accepting Bitcoins, and because of the structure of it, there is a limited capacity to Bitcoin. So the value of these things keeps going up. Now, they're highly volatile. I mentioned to you a while back, several years ago, you could buy a Bitcoin for $0.10. Well, just last year, I think it traded at $1,000. Now, they're down from that. But the fact is, you've got the kind of the rising of the electronic currency. And as you and I see disruptive technologies taking place in the world, currencies aren't far behind. And that leads to the whole Pandora's box of globalization. We're going to see more and more of that in our lifetimes. This is not something long future. This is near future. So be prepared for it. And as we go forward in the Master of Money, I've got some videos in the next weeks I'll show you that help you be comforted by that and not overly concerned. In the markets, we once again had the markets with a fairly nasty week. All three of the indexes were down. And again, this has been something that January's tried to start but hasn't been able to get there. We've got the Superstock guys are going to give us a very specific rundown of the markets later in the program. But we've seen kind of the markets reacting to the economy. The economy isn't on sound footing, so guess what? Neither is the market. The market is nervous. And so on good news, it tends to say, okay, I'm going to be there. But on any bad news, the participants are running away. And that's exactly what we would expect to see in this type of economic environment. Now, when we come back, as I said, we're going to talk about something that is as old as investing. It's called risk. And we're going to explode a major myth on Wall Street that has been used to snooker millions of you into making an investment that may blow up right when you turn 65. We'll be right back. I'm Steve Beeman, a 25-year veteran of Wall Street, most notable for selling my financial research firm to Charles Schwab. I've helped many folks just like you wake up and learn how to get out of debt, build sound retirements, and even pay for their kids' college. Path to Prosperity is my revolutionary 2-volume, 12-CD audio library that provides the keys you need to protect and build wealth in today's economy. 90% of Americans are concerned about their financial future. You can change that today by learning what you need to know from my extensive real-world experience. Path to Prosperity's 24 lessons are easy to understand and can be replayed time and time again. And through this TV offer, you can own it for a very special price. Don't put your hard-earned money or your retirement at risk. Take advantage of this opportunity before you commit to any investment, advisor, or expensive seminar. Let me help you find your way. This powerful tool can change your life. Start your path to prosperity. Welcome back to the program. When we talk about becoming a master of money, there are many dimensions to what that means. There's financial literacy, knowledge, understanding, and there's you learning to use the tools of the trade more efficiently and more sophisticated tools as you go along. Well, one of the concepts you need to understand is risk. Now, I'm not talking about the game that you play with your family that makes people make and break treaties that causes so much disruption in the family. I'm talking about the notion of risk from an investment perspective. What does risk mean to you? What does it mean to Wall Street? Those are very different concepts. And tonight, I want to go through what Wall Street has defined as risk and show you that just maybe it set you up for a trap. Now, as we talk about risk, there are lots of types of investing risk. There's inflation risk, liquidity risk, credit risk, business risk, country risk, all types of risk. But out of this just massive risk has Wall Street come to define it for you. In the 20th century, gave us a lot of growth in things. We got airplanes, we got computers, and we got modern portfolio theory. Now, the idea by Harry Markowitz, who developed modern portfolio theory and got a Nobel Prize for it, by the way, is that markets have two important dynamics. They have correlations, meaning that some investment classes are correlated or related to another class. We all would agree with that. And standard deviation, in that some asset classes are more volatile than other asset classes. Well, I think we'd agree with that too. Generally speaking, if you look at a one-year treasury bill, it's not very volatile. If you look at a year's worth of silver investments, it can be highly volatile. And some assets are correlated. We know that rising interest rates has falling bond prices. So both issues of correlation and standard deviation are embedded now into Wall Street's lexicon. And they've used that to talk and persuade you about what risk is. Well, I want to talk about these two issues here in a little more detail. Modern portfolio theory assigns asset classes. Let's define those as stocks, bonds, bills, in other words, government debt. You can talk about real estate as an asset class, commodities as an asset class. But modern portfolio theory tries to determine the correlations on these things. For example, if you're 100% in the stock market and the stock market goes a certain direction, what would that do to other asset classes that maybe you're not in but could have been? For example, it's long been thought that you have gold. If interest rates go up, gold should go in value, right? Well, the problem we have is some of these correlations don't always hold true. And if we look, for example, at 2008 and 2009, if any of you were invested in a 401k, you watched it become a 201k, because guess what? When stocks came down, so did bonds, so did gold, so did real estate, so did everything else. What shouldn't have been an investment inverse correlation among asset classes became all of them involved in that decline. And that's the problem. Sometimes in a chaotic downturn, what is statistically true over time doesn't hold true anymore. And so you get what should be a hedge in your portfolio by having uncorrelated assets that may not be true. The other concept is variability, and this is this thing called standard deviation. I've laughed frequently about how Wall Street likes to use big words to sound intelligent. All standard deviation is the measure against a central point of how widely something swings. You've all seen a graph. Some graphs go this much different, some go like this. That's a high standard deviation. It's not that difficult to understand. But the idea is that when you look at standard deviation and you say, for example, stocks are more volatile than bonds, generally that's a true statement. Well, when you take correlation, you add to it standard deviation, and you start to build an academic investment theory around it, you get some interesting outcomes. And one of the things you get is what's known as a target date fund. Now, many of you watching tonight in your 401k plan have been sold a target date fund, and it makes perfect sense. And let me explain the rationale. What a target date fund is, looks at your age and the years you have to your retirement. As you approach retirement age, it shifts your investments into more of a heavily bond-oriented portfolio. Based on modern portfolio theory, that should work beautifully. In fact, John Bogle, the legendary founder of Vanguard, said for every year of your age, you should be that percent in bonds. So this idea of the target date funds became the ideal, let's call it a set it and forget it investment. It will track your age over time. It will dynamically move you between large cap stocks, small cap stocks, growth and value and bonds, and everybody's happy. Okay, let me bring you down to earth a little bit. This academic theory is a little bit like the portfolio insurance that was sold by people in the 2000s that caused the economic malaise. It's an academic theory. In practicality, here's how it might just play out. You're right now sitting watching me, and you're 60 years old or 55. And you're thinking, okay, I'm going to retire in 5-10 years, so I'm going to follow modern portfolio theory, and I'm going to start increasing my allocation to bonds. Okay? I'd like to ask you, if you as you sit there, what happens when those bonds get hurt by rising interest rates? We know we're sitting in a world right now that by most economic theory should see rising interest rates. No guarantee of when it will happen, but we know that that possibility is there. So what's going to happen when millions and millions and millions of people turn 65? They go to their target date fund, which has them now heavily invested in bonds, and interest rates go up. Those people stand to be hurt very badly. This is a real concern. And if you're in a target date fund, please write me at questions@safefinancial.org. And I want to talk with you about something called tactical asset management. In fact, we're going to talk more about this. I'm trying right now to secure a special guest for next week's program in which we can talk about how people can dynamically go in and out of the markets. Not market timing, not by a long shot, but using the markets themselves as the generator of the timing signals. We know that risk control, to me, isn't standard deviation. Risk, to me, is losing money. I could have an asset that has very stable returns going this way, and I'm still losing money. Or I could have an asset that's up and down, all the way up, and I'm making money. So risk, as it's defined by Wall Street and defined for you to put you into a target date fund, is correlation of asset classes and standard deviation. I urge you to rethink your allocation to those things, because if, and I would say when, interest rates rise, the allocation into those bonds is going to get hurt. And guess what? There's a time when you could see stocks come down, gold come down, bonds come down, and real estate come down all at the same time. It may not be in the academic annals of history as a normal event, but we've seen it happen too many times. It's time that you were prepared for it. We have solutions to that kind of thing, and again, we're going to cover some of those next week. I only hope that we can get our friend Tim Newell to join us for that. I think it's going to be quite interesting. Now, moving into our super stock portion, we have a treat. What we're going to start doing is having this as a recorded or a live session from Jeff. If it's recorded or live, we don't really care. We want to get his insights into what's going on in the market. So, Jeff, let's bring you on right now. Jeff, give us your rundown of what's gone on in the markets lately.
Hey, Steve. Thanks for having me back to do a quick catch-up here. January of 2015 was a nasty month for stocks. Remember, January of 2014 was also a pretty nasty month as well. So through last Friday's close, we ended up the month with 12 down days and 8 up trading days. In addition, if we went back to last December, so December 2014, we saw 11 down days. So this has been an aberration since November of 2012 to get back-to-back months with 10 or more down days each month. And so the real big question is, are we now going to potentially have a third month, being February, with being down 10 days or more? Volatility is definitely key right now. We note that January 2014 saw 12 down days, so the poor seasonality of January definitely played out as we expected. More problematic, though, is the fact that there have been 8 days in January that have seen greater than a 1% move. 4 of those days were up more than 1%, and 4 of those days were a drop of more than 1%. January 2014 saw 5 such days as a comparison. So we're definitely higher than we were in 2014 in January. December of 2014 saw 5 such days. So in the last 2 months, we've had 13 such observations. Between May 1st and September 30th, the S&P had only 5 such observations that whole time. So you can say increased volatility. And if we included February in this data, yesterday we had a 1.3% move. So last Friday we were down 1.3, and today we're up 1.3. The one thing that the market has shown is a clear inability to hold gains or to actually hold losses, and we kind of move back and forth. I mean, this morning we're talking, we got up to 20, and then we started coming in off of that. So it's been very interesting to see how this whole thing has been playing out. We also know the VIX, which we've talked about before, has risen to above 20. In fact, it's now got a 20-day moving average of 18.70 through Monday's close. At the October low, this moving average hit 19 at its peak. And on January 20th, the VIX peaked for this year so far at 18.92, but we're rising back again towards that 18.92 and the 19 number. And it's a concern if that 20-day moving average heads towards 19 or even 20. We would also note that in the last 4 or 5 trading days, we've had 4 of the 5 days with moves of plus or minus 1%. So we're just getting a lot of volatility right now that's really not that explainable. And in that last 4 or 5 days, we had two such back-to-back down -1% observations in 2014 and 2012, and with one observation in 2013. Last week, the S&P lost 1% or more on Tuesday and Wednesday. So we're just all over the place. These observations are pretty rare and often coincide with a bottoming in the recent pullback. So that is one potential plus. As such, I'm kind of in the camp right now. I'm going to try and be a little more optimistic that equity markets could rise in February, but they're going to remain volatile. In fact, volatility is something we may have to live with in 2015 compared to 2014 when we didn't really have that very much. So that's it for now. Volatility is back in swing, and I'll turn it back to you. Thanks again.
Well, thank you, Jeff, for that commentary. We appreciate greatly the support of Superstock Investor, and we hope you found that information particularly insightful. As we said, Superstock is going to be part of our SAFE certified investment clubs, and we have a very good working relationship with them. So please mark your calendars for next week. As I said, I'm going to try to get Tim Newell to join us, and we're going to talk about a way to solve the risk dilemma, the risk paradox that you're in, especially if you're approaching retirement age. We want to hit that nail right on the head and make sure that you, as a master of money, don't have your path to prosperity disrupted. Well, as always, we want to thank our sponsors, Harvest Investment Services, who so closely supports us with information and resources. Superstock Investor, as I said, Ron Blake of Ron Blake Music, who gives us our music at the beginning, and Chris Yantz at the end, who's written such a beautiful theme song for us. I want to thank all of the participants, and as always, I want to thank you for spending this time with us. We know it's precious to you, and we can only hope that the content we provide is beneficial to your path to prosperity. We'll see you next week for another program of The Master of Money.